Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Jonah Lupton from Lupton Capital. Jonah is one of finance Twitter's most popular personalities with almost 600,000 followers. Jonah also writes a newsletter on Substack and was recently featured in The Hustle, the online magazine. And for good reason. Last year's portfolio generated a 423% return, and this year he's up 70%. I'll now introduce Paul Andriola.
Hey, thanks, Trevor. Yeah, really happy to have Jonah here. Jonah, I follow you on Twitter. A number of our subscribers follow you on Twitter. And recently you mentioned one of the stocks that we know fairly well, and you got some of our guys pretty excited. So I'm really happy to have you here. And one question I got to ask right at the top is, with all the things you do, I mean, do you even sleep? Do you get any sleep?
I always have a glass of iced coffee next to me, and usually a couple Celsius drinks on the other side. So I don't get enough sleep. I mean, that's something that I'm trying to pay more attention to, is my health. I do go to the gym every day, so I try to work out an hour and a half, typically after the market closes, and then come home and do more work and research. You know, get into bed at 11 o'clock at night, but then usually I'm up until 1 or 2 in the morning, especially if I go on Twitter. You know, then you start to get into conversations with people. Next thing you know, it's 2 o'clock in the morning and the alarm goes off in 4 hours. So, so to answer your question, not enough.
Gotcha. Well, we'll work on that. As Trevor mentioned, you manage capital. Obviously, you've got your own sort of capital, Lupton Capital. You also manage money for social capital. You're right in the middle of the small cap space. Why don't you tell us, how did it start? How did you get started investing?
So my career goes back till 2002 when I got out of college, and I immediately started working for Morgan Stanley. So I spent a few years at Morgan Stanley, then spent a few years at Smith Barney, spent a few more years at a couple different trust companies. And then after the financial crisis was over in 2011, I guess it was 2011, I needed a break from the industry. You know, those 2 years or 2.5 years of the financial crisis were just really mentally and physically draining on me, you know, dealing with high net worth clients. It was brutal for me. You know, when I came into the business in 2002, I just missed the dot-com bubble, thankfully, because I'm sure that was probably as bad, if not worse, to actually manage money through. So I walked away from the industry, started a couple companies. I was running a business called SoundGuard as of last year. You know, going into the pandemic, the business was actually doing well. We were lined up to do, let's say, $3 million of projects in the second half of last year. And then the pandemic basically wiped it all out, because most of these projects were hotels and apartments, and all of those projects got postponed. So then I kind of pivoted back into the investment industry, where I obviously had some experience. I got on FinTwit, you know, Twitter finance, and started talking to a lot of people, launched a Substack, launched a Stock Twits Room, got into the Social Capital Emerging Managers program. So I am doing a lot of things right now, but I enjoy it. I mean, there are certain days where it's obviously stressful, and, you know, in small cap growth stocks, you know, I've done very well the first 6 to 8 weeks of this year, and the last 6 to 8 weeks have not been as much fun. But, you know, when you're dealing with small cap growth, as you know, you got to be able to ride through the volatility. I mean, these stocks, you can put up big returns, but in order to get those big returns, you're going to have to deal with, you know, some big pullbacks along the way. And not everyone can handle that, you know, and they get shaken out, you know, towards the bottom, and then they end up chasing these stocks higher. You know, I have the kind of the long-term investment horizon, so I'm willing to, you know, stay in these stocks and deal with the pullbacks and keep adding to positions, dollar cost average down if needed. Because if you've done the homework and you really believe these companies, you know, have the ability to 5x or 10x over the next 5 years, then it's stupid to get shaken out, or at least that's how I look at it.
Mm-hmm. I completely agree. Let's talk a bit about your investing strategy. Let's dive right into it. What do you look for in a company that you're hoping to invest in?
So my strategy has definitely changed a little bit over the last 12 months. Last year, I was primarily large cap tech. So it was a lot of the companies and sectors that were benefiting from the pandemic, from the digitization of the economy, right? People working from home, e-commerce, digital payments. So that's where most of my focus was. Companies like Shopify and CrowdStrike and Peloton and Fastly and Twilio and those sorts of companies. And then as we got towards the end of the year, I felt like a lot of those valuations had gotten stretched. The multiples had gotten stretched. We were going to start to get into 2021 where it would look like revenues were still increasing, but the growth rate was decelerating. And then you'd also get into some harder comps in Q2, Q3. So I was in a low tax bracket last year because all of my income had dried up because of SoundGuard. So I used that to my advantage and sold off a lot of those positions before the year was over to lock in those cap gains last year. And then this year, I've really had much more of a focus on small cap growth because coming into the year, I felt like that's where there was going to be more opportunity. And especially as I was growing my newsletter, I don't know if people in my newsletter want to get a newsletter about Facebook and Amazon and Nvidia and Tesla. I mean, there's a million guys out there that are writing for those companies. There's 30, 40, 50 analysts covering each of those companies. No stone has been unturned with those companies. But when you get into the small cap space, there are a lot of companies out there doing exciting things, high growth rates, disruptive products that have almost no coverage. They're completely under the radar. And I felt like that's where I could not only find the best opportunities for myself, but also bring these opportunities to my Substack subscribers. So I've been, full on small cap growth since the beginning of this year. And like I said, I mean, it worked out great the first 6 to 8 weeks. I was up 120%. And now we've seen a pretty significant pullback in some of my favorite names. But, like I said earlier, I'm looking for stocks that I can own for the next 3 to 5 years. I will not put a company in my portfolio unless I believe it has the potential to go 5x in 5 years, which would be a 38% compounded growth rate. And I still believe that, whether it's DermTech or Upstart or Celsius, some of my other favorite companies, I think these stocks have the potential to still go up 5x over the next 5 years. I think DermTech could be, if they can deliver on what I think they can, in terms of, using their genomics patches for early skin cancer detection. I mean, this, 5x is nothing compared to what the skin cancer market might look like in 5 years. I mean, this could be a 10 or 20xer in my portfolio.
Mm-hmm. No, I'd love to talk to some of the names that you're involved with, but before we get there, how do you find your ideas? How do you look for them? How do you search them out? And are you a top-down investor? Or are you a bottom-up investor?
So in terms of finding them, I mean, it does vary. I do think that Twitter is actually a decent place to get some ideas. I mean, there's a lot of noise on there that you have to cut through, but over time you figure out who else is doing quality research and trying to find these companies as well, and that's who you want to keep, stay close to. So I'm constantly, a lot of what you see from me is on public Twitter, but I would say most of the value that I get off Twitter is like the private side of Twitter, the DMs. That's where you can actually have one-on-one conversations with people, share research, share links, and then eventually that leads to Zoom calls and other things where you can, dive deeper together. So I would say probably half of my ideas come from Twitter. I would say another portion come from either podcasts, other people's Substacks. So they're doing write-ups on these companies, trying to bring some attention and awareness to them. So I'm probably on 50 or 100 different newsletter lists, Substacks, blogs, etc. And then some are coming from podcasts or just my own screeners. So there's 2 or 3 different stock screeners that I use. None of them are that great. Like, I don't love any of them particularly. I'm actually thinking about creating my own since I started a company called Fintrix to help people do fundamental analysis. And we actually subscribe to all the data from a company called Refinitiv. So if we're already paying for all of that data, both historical and future looking estimates, we have all that data, all we have to do is basically, now we have to build a screener. we're already paying for the data, so we might as well try to use the data in every way we possibly can. But for now, I use the stock screener that I use the most often it's called Atom Finance. So it's atom.finance is the website, and it's pretty good. You can put in, growth rates for whatever years, they use the current year as 0. So, if you're looking for companies that are growing, top line 40%, this year and the next 2 years, you would put in, revenue growth, year 0, 40%, and then, +1, +2, 40% each, market caps. And then if you're looking, any other metrics that matter to you, you can plug in there as well. And, typically, depending on how specific you're getting, you're going to, you might get 20, 30, 40, 50 stocks returned to you. And then it's just a matter of going through them and, trying to identify any stocks that you think might have potential. I typically stay away from the biotech and the pharmaceutical names. I just don't have enough expertise in those areas. And there's other sectors that I stay away from that I just don't really understand. So I typically stick with, fintech, medical devices, ag tech is kind of a new one for me. Of course, EV and clean energy, and a few others as well. I mean, as you go through my portfolio, you'll definitely see themes. 3 or 4 sectors typically stand out as being over concentrated in.
Gotcha. So by the sound of it, the screening itself is a bottom-up approach, but you sort of stay in certain silos. You stay away from other.
Yeah, I mean, I would say for the most part, I'm bottom up. I mean, sometimes if I really want exposure to a sector, I will start with the sector and then try to parse through it. And especially if you're really focused on small caps, so cybersecurity was one that I was really interested in recently. And I've been looking, ever since I sold CrowdStrike last year, which is still a phenomenal company, although it's also trading at like 30 times sales. And growth is going to eventually slow over time, just law of large numbers. So I wanted to find a small cap, high growth cybersecurity company, and I looked at 3 or 4, and they just didn't really do it for me. And then someone brought me this new company called Intrusion. And ironically, I did my Substack write-up this week on Intrusion because I think it's a really interesting company that is transforming themselves from what used to be exclusively DoD work, Department of Defense, into now an enterprise company. And then, of course, this morning, a short report comes out on the company. So, I read through the short report. 90% of it is absolute garbage. Sometimes short reports do have some validity to them. They do bring up some real points and some real red flags. This one did not for me. They talked about insider selling. They forgot to mention that the founder of the company died a couple of years ago. So it's actually his family that inherited all of his stock that's doing the selling, right? So that's pretty explainable if they actually want to tell the whole story. Of course, they just, they pick out the pieces that make the, to build up their short thesis. So, the timing on that kind of sucks, but, in terms of, I know one of your earlier questions was, or I think you were going to ask this, my due diligence, I've done a decent amount of due diligence on this company, and I'm just picking this one just because they're being attacked by the shorts today. I went through, of course, the investor presentation, listened to the last 2 or 3 earnings calls, went through the 10Qs, the 10Ks. Then I set up calls with the analysts to cover the stock, talked to them, then set up a call with investor relations, then talk to someone on the sales team. So that's pretty much all I can do. If the company's lying to me, if investor relations is lying to my face, or if the CEO is doing interviews on, Bloomberg and lying on the earnings calls, well, I can't control that. I mean, that's obviously something that would blindside me at some point if it comes out that they were lying. But if I'm taking everything that they're saying at face value, and that all of this technology and this data that they essentially built up over 30 years of working with the DoD, and then after the founder died, previous CEO was the founder, he passed away. They brought, they had an interim CEO in there for a little while, and then they brought in this guy Jack Blunt, who's a industry veteran and sort of a turnaround specialist. They brought him in, and he realized how much of an opportunity there was to use this data with artificial intelligence to build a product for the enterprise. So that's what he did. He packaged it all up and created this product called Shield, which they are now selling to not just large enterprises, but also SMBs through their 30 resellers. And they just landed a big deal with Kimberly-Clark and Lippert Manufacturing. And he says that they have a massive pipeline. You know, the words he used on the earnings call were, in 42 years of being in the technology industry, I've never seen a product launch and build a pipeline this fast, this robust. Those are his exact words. If he's lying to us, then okay, we'll figure it out eventually. But if he's being honest and I'm taking him at face value, then there's a huge opportunity with this company. It's not really being misunderstood. It's not being understood correctly by the market. So when I'm looking for my stocks, I mean, I'm looking for, you know, strong fundamentals, so high growth, you know, let's say improving margins. You know, a lot of these companies that are growing at 100%, you know, they may not be profitable yet, but I at least want to see a path to profitability. So I want to see those EBITDA margins improving, those net income margins improving. You know, how efficient are they with capital? How often are they, you know, being forced to raise capital in order to keep growing it, you know, at this pace? You know, and what is that dilution doing to the, you know, the share count? So all of that stuff matters, but for the most part, I'm looking for companies that are growing at least 40% a year, a reasonable valuation. You know, if the company's growing at 40% a year, I'm willing, you know, depending on gross margins, I mean, I'm willing to pay, let's just say 10 times, 15 times sales at the most, but I'm not paying 30 times sales for a company that's growing at 40%. Like that's where you get yourself in trouble. So growth, you know, improving margins, strong management is obviously a nice thing. You know, a sector that I think is either ripe for disruption or very large, and, you know, they're able to, you know, compete against, you know, whoever the big boys are in that industry and take market share for whatever reason, which is kind of my thesis behind Celsius, the energy drink company. And then the last thing I look for is a catalyst. I want to know that there's catalysts on the horizon that can move this stock price higher, whether it's just the story's not understood correctly, or I have a belief that they're going to beat earnings handedly and then raise guidance, which is what happened to Upstart. So whatever that catalyst might be, you know, FDA approval sometimes is one of them. You know, that's one of the reasons I was in Transmedics, because I thought they would get FDA approval for OCS Heart. That would move the stock 25, 30% higher. You know, the FDA panel hearing was a couple weeks ago. The vote was yes, but the comments were kind of negative. So the sense is that the FDA will approve it for heart, but there's going to be restrictions on it, which may limit the size of the market opportunity for OCS Heart. So, you know, sometimes you bet on this company based on what you think the outcome is going to be. You actually get the outcome that you want, but then the stock acts negatively. So, you know, you just, so that's when patience and conviction and, you know, trying to have a long-term mindset, you know, definitely pays off. I mean, because I still think Transmedics could be a great investment for someone if you can look 2 or 3 years out, you know, because after they get FDA approval for OCS Heart for DBD, which is donation after brain death, you know, next they have OCS liver, and then they get to OCS for DCD, which is donation after circulatory death. And that's really where the market opportunity opens up for Transmedics. So if you can be patient and wait for those catalysts to play out, I think you can make some money in that stock.
Gotcha. How important do you find analyst reports? What if a company's not covered? Does that help or does that hinder you?
I mean, it's a little scary if there's no analyst to cover the stock. I don't think I own any stocks that don't have any analysts covering. In a lot of the cases, there's only 2 or 3 analysts that cover, and I usually try to reach out to all of them. I mean, they're not all willing to talk to me, or they don't all respond to me. But for the most, and then investor relations is pretty good. You know, if I reached out to investor relations from Facebook, I would probably never get a reply. But if you reach out to investor relations for a small cap company, you actually have a pretty good chance of getting a reply. Now, it's typically not someone that works at the company. It's one of these, you know, these like investor relation firms that represent 3, 4, 5 different companies. So ironically, there's some investor relation guys that I talk to that, like, when I get on the phone with them, I can actually talk about 2 or 3 different companies because they work with 2 or 3 of the companies that I'm interested in. I mean, the other challenge when you're dealing with small caps, and there's only 2 or 3 analysts that cover, that's where the estimates are typically coming from that you see on Yahoo Finance or Bloomberg or Ticker or any of these other sites. So you see these very large spreads. For instance, like on Intrusion, I think the consensus is 24 million in revenue this year, but there's only 2 analysts that cover it. So if Scott Buck is at 25 and the consensus is 21, that means the other guy's at 17. So you got an $8 million spread between the 2 analysts, which is a pretty big gap. I mean, the good side of that, or the upside, is when you have these big spreads, you get these big either beats or misses around the earnings. So that's where you can get some increased volatility. Not sometimes it's good, sometimes it's bad, depending on how the stock reacts. But that's where for instance on Upstart, I think only had a couple analysts covering the stock going into their last earnings report. And so when they blew out numbers, well, they didn't blow out numbers for Q4, but when they raised guidance for 2021 from 360 million to 500 million, it caught everybody off guard because there really wasn't any analyst covering the stock. No one saw that coming. The analyst, since there's no analysts on the company, there was just, there was really no institutional money in it either. A lot of these big funds are waiting for the analysts to pick up coverage. So I don't know if I would ever, I'm trying to think, I don't know if I'd ever own a stock that had no analyst covering, because then it's really just me doing 100% of the work myself with like nobody really kind of fall back on for help.
Yeah, fair enough. So what does an average day look like for you? A work day, what does it look like?
Up at 6:30, turn on CNBC, see if there's any news, check out pre-market. Although I think we know by now that, whatever you see pre-market is really no indication of what's going to happen during the day. It's almost a waste to even look at it. I mean, these markets change their minds so quickly, especially small cap growth. I'm not one of these guys though that really, like, I don't pay a lot of attention to the indexes. Since I am so focused on small cap growth, I'm really I feel like I'm in my own little kind of bubble sometimes. I don't really care what the Nasdaq's doing. I don't really care what the S&P is doing. Certainly don't look at the Dow, because those stocks and how they're moving day to day really shouldn't impact my thesis on my own companies. I mean, I get it. I mean, I know the averages do mean something in terms of like, technical traders and the big funds and the algorithms and all that stuff. But for the most part, I am really just kind of focused on my company. So most of my day is spent doing research on my existing companies or any stocks on my watch list that I have an interest in and could see myself adding in the next month or so. And then, I'm talking to other retail investors, other fund managers. So a lot of times if I see a stock, so Simply Wall Street is one of these websites that I use a lot because you can actually see the top 25 shareholders. So if there's a company that I'm interested in that I don't have a position in yet, and I'm going through the due diligence process, I'll go to Simply Wall Street, type in the ticker. I can see who the top 25 shareholders are. There's always going to be a couple insiders on there, whether it's the founder or the CTO, but then you'll see a lot of the funds on there as well. And, the bigger funds, the Fidelities, the BlackRocks, the Vanguards, they're in a lot of these small caps as well because they have so much money to manage. I'm not going to reach out to them, but if I see any smaller firms on there, smaller money managers, especially if it's like an independent small cap manager, I will reach out to them. I'll typically go to their website, pull off the contact information, and try to set up a call with whatever portfolio manager or analyst from the firm covers that stock, just so I can kind of pick their brain. How long they've been in the company, what do they like, what don't they like, what has management said to them recently, what are they expecting for earnings this year. Sometimes they're more forthcoming than others, but I'm just one fund manager talking to another. So I've gotten, that's been helpful over the last couple months as well, trying to reach out to these fund managers. So that's kind of my day. It's reading, it's researching, it's listening to earnings calls, listening to the most, seeing if the company's updated their investor presentation. I'll go on Twitter, even though it's kind of a waste of time sometimes, but I'll go to Twitter, type in the ticker symbol for some of my stocks and just see what people on Twitter are saying about my company. But then I also run a stock twits room. So I'll go in stock twits and, share some stuff on there, whether it's charts or some research I came across. And then sometimes I'll post in there, any buy or sell orders that I have open for the day. And then, so whatever time I'm not spent researching or talking to other investors, it typically spent, micromanaging my portfolio or staring at the red screen recently, wondering when the bleeding's going to stop.
No kidding. No kidding. One thing I noticed, you're extremely transparent with your trades and your transactions. How do you buy and reversely, how do you sell? What will really drive you to buy something? How big do you establish your position when you start buying? And then what really makes you sell something?
Yeah, so I mean, my strategy is definitely, I feel like it changes all the time depending on what the market is giving me to work with. Back in late February, when my stocks were, felt like they were going up 3, 4, 5% every day. I mean, it was too easy to make money back in February in small cap growth, which I guess in hindsight should have been a little bit more of a warning to me. I probably should have trimmed my positions a little bit more aggressively. But typically when my stocks start to really move and move fast, if I think they're getting overextended, I will trim them back and I'll either sit in cash or most likely I'm going to look for other positions to either add to or to start new positions. Because, my whole thing is, stocks are not always moving together, right? While some stocks are zigging, some stocks are zagging, some stocks are, bouncing off of a moving average and ripping higher, while other stocks are in the process of pulling back to a moving average or support level. So if I'm trimming from one stock that feels like it's getting overextended, I want to, add that cash to one of my other positions that feels like it's being oversold. So for instance, today, one of my positions, Futu, which is a kind of the Chinese version of Robinhood. I've owned the stock since December. It was up, I think, almost 10% at one point today. So I was trimming a little, just minor trimming, trimmed about 5% of my Futu position and added that to some of my other stocks that were laggards today, like Mohawk, Intrusion, Upstart. So I'm constantly kind of shifting capital around depending on what the markets are giving me to work with. Mm-hmm. Back in February, my portfolio, and this is something I regret, I was adding too many positions. I got sucked in to the whole SPAC mania thing. There was all these exciting SPACs coming public with all these huge growth numbers and these, the vision to, completely flip an industry on its head. And, I got sucked into some of that excitement. So I was adding some of these SPACs to my portfolio and they were doing great. A lot of these SPACs were, they were the fastest runners in my portfolio. But when we start to get that correction, they were the first ones to fall as well. And, so I recognized that pretty quickly and dumped a lot of those SPACs. So I took my portfolio from about 40 names down to 20 names. Right now I'm about 15 names. So that's sort of, I guess, how I run money. That's what feels most comfortable to me is when the markets start to pull back, I'm going to trim let's call it the bottom third of my portfolio and double down on my highest conviction names. Just the names. And then the other reason I do that, at least in my portfolio, some of my highest conviction names are also my highest beta names as well. So, there were stocks, even when the growth stocks pulled back in late February through mid-March, I had a few stocks in my portfolio that held up really well. One of them was InMode, INMD, MP Materials, and a couple others. They held up really well. In some cases, they were actually higher in mid-March than they were in late February. So I sold those stocks and added that cash to these stocks that had pulled back 20, 30, 40%. So I did the same thing a couple of days ago. I sold my Ozone, which is a Chinese e-commerce company, which has held up really well the last couple of months. Sold it, took my profits, and reallocated that cash into my stocks that have recently pulled back the most. So I don't mind betting big on my highest conviction names because I feel like when they finally find that bottom, which is hopefully coming soon, they'll bounce the hardest.
Mm-hmm. Mm-hmm. Now, so I was involved in a couple startups. I've been a founder of a couple companies. Clearly, you've been involved in founding and starting up companies. How has that helped you as far as your evolution as an investor?
Yeah, someone asked me this the other day, kind of caught me off guard, and I said I didn't really have a good answer, but I've sort of thought about it since then. And I do think if you're a startup founder, you have to have tough, first of all, you have to have thick skin, because you're going to get a lot of rejection. You're going to have a lot of, late nights at the office, stressful days, hiring, firing, almost running out of cash, talking to pissed off investors, dealing with customers. Like, you got to really have thick skin. You got to be really, you got to have great time management skills as well. And, probably for that, good communication skills. But I also think there's a part of it, you have to be a risk taker. Like, risk can't really bother you. Like, when you're running a startup, I mean, like, at least when I was running SoundGuard, I mean, it felt like every month we were almost running out of cash. And like, at some point you just become immune to the risk. And I think if you're going to invest in especially small cap growth, like, I sort of think you have to have that same mindset. You can't be afraid of risk and volatility. You almost have to embrace it and use it to your advantage. And like, that's how I feel with my personal. So running my personal account is way less stressful than running the social capital fund, because the social capital fund is not my money, right? It technically belongs to social capital. So when I lose, $100,000 in that fund one day, like, it pains me more than when I lose 100,000 in my own personal fund. And I don't know, it might sound weird to some people, but that's just kind of how I am. Like, I take more risk in my personal fund than I do the social capital fund, because I don't mind it. Like, it really doesn't bother me. Like, if my portfolio is down 30-40% in the last few weeks, I mean, and I'm sleeping fine. I mean, I'm not sleeping, but it's for different reasons than my portfolio being down, because I've done, I believe in my stocks. I've done the due diligence. I think I know where these companies can be trading in 6 to 12 months. So I don't care what they do tomorrow or the next day or next week, because I believe that they're going to be significantly higher in 6 months, 12 months, 18 months, etc. So like, I can drown out that short-term volatility and just focus on where I think these stocks could be trading 6 to 12 months. And, if I'm right and, my thesis plays out, then the stock price will take care of itself. So, that's at least the first thing that comes to mind, is just, when you're an entrepreneur running a business, a startup, risk is just part of your job. And I think that carried over to running money, where volatility, the only thing that bothers me is when shorts come after a stock and lie in the report and my stock goes down 15%. That's what bothers me. Like, I mean,
it's hard to control that. Yeah.
Right. Exactly. Like, if the company missed earnings and was down, I'd be mad at myself, for putting too much faith in the company. But then that also presents an opportunity. Like, for instance, Celsius is one of my largest holdings. I've been buying this stock every week since last summer, so summer of 2020, when it was in the teens. So I started buying Celsius. It was a $14 stock. It's now at 57, down from a high of I think got to 74 a couple months ago, but it's been creeping back up. But in Q3 of 2020, they put up an 80% year-over-year growth number, because they were just killing it on Amazon during the pandemic. And then I think a lot of people were expecting a higher number, or at least a better number in Q4, and they only came in at about 54%. So the stock sold off 20-25%. But what people were missing about the story is that the company is in the process of switching from DTR, which is direct to retailer, which means they're shipping product to the retailer's distribution center. And then it goes from the distribution center to the store, and someone from the store has to stock the shelves. That's what DTR is. That is a painful process with a lot of, mistakes that get made in between. But they were switching from that to DSD, which is direct store delivery, which means they work with these DSD partners. And this is who Monster works with, Red Bull, Coca-Cola, Pepsi, all the big brands. DSD means your product goes on the truck the truck brings it to the store and stocks the shelves themselves. So all the big boys use DSD, and now Celsius is finally, in that game, or at least they're in that big boy crowd where now the DSD partners come to them. The other part of the story is Rockstar, which is a garbage company, garbage products. They try to be like the next Monster, but it's just a garbage product with a bunch of chemicals and artificial flavors. They had an exclusive distribution agreement with Pepsi. Pepsi could not sell or distribute any other energy drinks. So the only way that Pepsi could get out of that contract was to buy Rockstar. So last year they bought Rockstar for $3.8 billion, even though it's a declining brand with declining shelf space. They bought it just so that they could start selling other energy drinks. So they went, as soon as they did that deal, they went directly to Bang. Bang's probably number 3 in terms of market share behind Red Bull and Monster, just ahead of Celsius. They went to Bang and said, hey, we want to distribute for you. Bang said, okay, fine. Bang walked away from all of their DSD partners to go work with Pepsi, and which opened up the door for all of those DSD partners to come to Celsius. So that's who Celsius has been able to bring on over the last few months, 150 of these regional DSD partners that used to work with Bang that now they get to work with. So like the story was there, people just didn't understand it. So the stock got pounded after they reported Q4 earnings. And I think over the last couple of months, as people have started to understand the story, now they've jumped back into the stock. So.
You've mentioned the word conviction a number of times, and what I've always seen is that, especially those involved in startups or anybody who's been involved in running their own business, I mean, you have to have high conviction in running your own business, and be able to translate that into as an investor, I think is really important, because, I mean, we've seen some of the biggest winners in history that have 50-60% drawdowns, and if you don't have the conviction to hold on to these things, you're going to miss these big winners. Do you agree with that?
Oh, for sure. Absolutely. So that's probably something else that I learned as a startup entrepreneur, right? Because you start a company, at least in the case of SoundGuard. I mean, I knew this was going to be a 5-10 year journey, right? I mean, the first 18 months was just developing the product. And then I had to go out and raise money from investors. And then we had to spend the next 6 months going out into the field and doing demos for customers. And then another year trying to get into these projects. So, I mean, we were basically in year 4 before we even generated $1 of revenue and before I could even pay myself anything. So like, if you're going to be, startups, typically, I mean, you really have to have a long-term mindset and be willing to make a lot of sacrifices along the way and stay patient and have conviction in your idea or your product or, your business model, whatever it is. And I think that's sort of translated over to small cap growth investing, where, if I've done my homework and I believe in where this company can go over the next 3 or 4 years, I better have conviction. I better stay in that name and be patient. Otherwise, if I'm actually right, but I get shaken out, then I don't get to enjoy the upside. So, I mean, conviction works both ways, though. I mean, you're not always right. I mean, sometimes you can have conviction and be wrong, and you just keep dollar cost averaging down, and it just turns into a bigger and bigger loss in your portfolio, and you never really, dig yourself out of that hole. So, I mean, at some point you have to look at yourself in the mirror and be like, okay, am I holding on to a dog, or is the market going to eventually understand this, or is there some catalyst that's going to move this stock higher? And sometimes you just have to decide to, take your losses and move on. Other times that conviction eventually pays off. So, Upstart, for instance, I mean, even though it's only been a few months, I mean, that stock was at $40 in December when I jumped in and did my Substack write-up. It ran all the way up to 100. I trimmed a little bit, but only like 5 or 10%. It pulled all the way back to 50. I stayed in it, and then it reported those Q4 numbers, and the thing blew up to 168. Wow. So, I mean, a lot of people got shaken out on the pullback from 100 to 50, never jumped back in, and then missed that move from 50 up to 168. So, but recently, I mean, there's plenty of stocks in my portfolio that I loved them at 40. I loved it more at 35. I loved it even more at 30. And it's like, just like this bleeding hole in my portfolio. But if I say that I'm a long-term investor, then I really shouldn't be worried about 3 weeks of pullbacks. I mean, like Mohawk is one of my favorite companies right now. I posted a chart on Twitter today. Mohawk was at $49 a couple months ago. It's pulled all the way back down to 26. So we're talking 45% pullback. It's now sitting on its 100-day moving average. Like for a stock that is, going to be profitable this year for the first time, growing revenues at 100%. They're going to generate $31 million of EBITDA this year. So they're trading at 25 times EBITDA with the 100% top line growth, and it's pulled back to its 100-day moving average. Like to me, that's a pretty safe place to get in, or at least a safe place to keep adding to the position. So,
gotcha. Tell us about your biggest regret in investing, or let's say your biggest investment, sort of mistake that you learned the most from.
So my two worst mistakes this year were, one was called Frequency Therapeutics. So they were making I call it like a regenerative medicine. So it's a shot inside your ear that is supposed to help regrow your ear hairs, basically, to bring back the, your ability to hear. I mean, I'm obviously simplifying it, but they reported some what they call phase 1 half trial, or like half phase 1 trials. So basically halfway through phase 1 trials, they reported numbers that actually looked pretty good on the surface. So I got pretty excited, added to my position. And then 2 weeks later, they reported the additional numbers that looked much worse. So I got blindsided by that. And that's sort of when I realized that that's just not an industry that I should be investing in, therapeutics and whatnot, especially that early on, phase 1 trials. That's just too early for me. That's too binary of an outcome. Now, thankfully, this was sort of those, one of those moonshot stocks where I felt like it was either going to, it was a $40 stock. So I felt like it was either going to 100 or it was going to 0. And unfortunately, it went closer to 0 than 100. So after they reported those bad trial results, the stock dropped 80%. So, it was a 1% position. So losing 80% is painful, but it didn't blow up my entire portfolio. So I just think, that's just a reminder to people. It's okay to have some of these riskier positions in your portfolio, but just make sure that you understand, the downside to them, and that you position your portfolio properly so that if one of these stocks does blow up and go the wrong way, it doesn't kill your entire account. The other one, and this one's even more painful. It's a company called App Harvest. So they're in the vertical farming space. So the company's only 4 or 5 years old, so they're still pretty new. But most people understand that farming is done outside in big open fields. And in most parts of this country, you can only grow outside so many months out of the year because of weather conditions. And then you have insects, and you have chemicals. So there's a lot of reasons why indoor vertical farming is optimal compared to outdoor open field farming. So Jonathan Webb started this company, like I said, back in 2017, took it public back in the fall through a SPAC. Steve Case from, the former AOL guy, he was an early investor in the company. Martha Stewart's on the board of directors. But indoor vertical farming brings a 30x yield per acre compared to outdoor farming, because they can grow indoors, they can grow year round, they can grow as high as they want, they can do it without any insects or pesticides. They used recycled rainwater, so they collect all the rainwater in a 10-acre retention pond, recycle it, purify it, and shoot it back into the facility. So they built their first facility in Kentucky, Moorhead, Kentucky, 2.8 million square feet. It's just like 50 football fields, just massive. And they're growing tomatoes there right now. And then they're building 2 more facilities as we speak. One's going to grow peppers, and one's going to grow, I believe, lettuce or cucumbers. And the goal is to have 10 or 12 of these facilities all around the country, within 3 or 4 years. And each of these facilities is going to crank out, 50 to 100 million pounds of produce every year, because the US imports almost 50% of their produce, mostly from Mexico. So if you think about it, I mean, God knows what, down there, who knows what kinds of pesticides they're using, child labor, but like half of the cost you're paying for produce is the transportation cost to bring it from Mexico up to the US. Whereas Kentucky is actually, it's more centrally located than people realize. And they say that 90% of the US population is within a 1-day drive of Kentucky. And 3 of the largest logistics hubs in the country are all right in the Kentucky area. So, Amazon, FedEx, and DHL. So it's a really cool company. They just bought a robotics company. It's like a robotics AI company. So they can actually use robots now to pick the produce, and the AI helps identify the perfect time and ripeness to pick them. But I chased the stock. I got sucked up in the story of vertical farming and how this is the future of food supply and blah, blah, blah. And I chased the stock and I overpaid for it. And the thing got crushed like 50 or 60%. So like, I think that's where I need to do a better job of separating the story and the valuation. Like, just because I love a story and I love the company for what they're doing and their mission and everything else, I need to be a little bit more disciplined sometimes on what I'm willing to pay for that company in the present time.
What I've done a fair bit of research in the space as well. And one other thing I'll add is that for a head of lettuce in the Salinas Valley, it takes 26 gallons of water to grow 1 head of lettuce.
That's crazy.
It's crazy, isn't it? And now it's in that type of farming, it takes as little as 1 gallon. So you're saving a massive amount of water.
Yep.
And a lot of people are admitting that water is going to be a big, big issue, obviously, as we go forward.
Agreed. Just look at all the the harsh weather conditions we've had over the last couple of years. The Midwest, even down in Texas, of course, the fires in California. And all of those things are a threat to open field farming, but they really have no impact on indoor vertical farming. So, I agree that this might be, part of our future. Maybe in 20 years, we have, 100 or 200 of these facilities all over the country. So I think it's exciting. I also think the part that I underestimated was, in order for this company to finance all of that growth and finance the construction of all these new facilities, and each one costs about $125 to $150 million to build, where's that money going to come from? It's going to come from debt. It's going to come from new shares being issued. So, there's going to be a lot of dilution in the future as they ramp up this company.
Gotcha. So you're obviously a significant personality in FinTwit. You've been around the markets for a while. How do you see social media changing the investment industry?
It's a good question. I think I probably came in at the right time, as a lot of people last year were, losing their jobs or working from home. So they were able to spend a little bit more time on their investment portfolios. And I think it's like, I think it's good that retail investors are out there trying to do it themselves. I would argue that a lot of those people should still not be doing it themselves. I think it's fun to try to find stocks and it's fun to trade your account. It's also, it can be very time consuming and stressful if you're doing it the right way. So I think there's, we've seen this explosion of retail investors, mostly because of, not just people working from home, not just because of the stimulus checks that were going out, but because commissions have gone to zero, so now you can, Robinhood really sort of accelerated this whole retail and investing thing. So, I think, so I used to work at Morgan Stanley Smith Barney. So I used to go after all these high net worth investors and convince them that they shouldn't be managing their own portfolios and that they should pay me 1% a year to do it for them. Like, now that we've moved into this new age of technology and, everything that we need is at our fingertips and, data is becoming cheaper and cheaper. I just think there's more people out there, especially the younger investors, the millennials, that think they now have the tools to do it themselves. And I don't know, maybe in 5 years, we'll know if that was actually a good thing or not. I think like there's people out there that love ETFs and index funds. I'm obviously not one of them, but I do think for a lot of new investors that are, trying to manage their own portfolio, a lot of them would be better off just sticking with index funds, rather than trying to manage their own portfolio of individual holdings. So, because learning lessons the hard way with your own money is not easy. I mean, and that's why I do teach some quarterly webinars that I call Investing for Beginners. And the idea is to try to educate young people on how to get started in investing and do it the right way from the beginning. And I talk about, like, the reason you want to start at a younger age is because you're dealing with small amounts of money. That's the time to learn the hard way. Like, that's when you want to make the mistakes, is when you're dealing with smaller sums of money. Don't wait until you're 40 and you have a much bigger chunk of money to start doing it yourself. That's not when you want to start making a mistake. So, I usually say, like, start slow, start small, and make mistakes. And then as you get older and you start making some serious money, now you have a better idea of what you're doing. But even with that said, like, there's still a lot of people out there that just don't have the time or the temperament to really be managing their own portfolio. They get too emotional. And when you get emotional over your stocks, that's when you typically make bad mistakes.
Completely agree. Completely. That's fantastic advice. So you mentioned earlier that you do a lot of outreach and talk to a lot of people on Twitter and other social media. Maybe talk a bit about that. Like, have you met some other influential investors? Who have you met? Who would you recommend people follow? Who are your favorite investors to follow?
Oh boy. I mean, what I've learned is, like, everyone really has their own style. So a guy like Brian Feraldi, who works at Motley Fool, he's really, like, he'll own 100 stocks and he'll own them forever. Like, he's not a trader. He doesn't get sucked up in the short-term noise. I mean, he's really, like, set it and forget it, which I could never do. Like, first of all, I don't want that many stocks in my portfolio. And, like, I'm just not, like, even though I say have patience, I'm not willing to have patience on all of my stocks forever. I mean, there's still reasons that I sell them. So I can't, like, buy a stock and just not be willing to sell it for 5 years where he can. So I give him credit. Like, you have to have a really special kind of temperament to be able to do that. So, like, and then there's guys like Mark Minervani, I can't even pronounce his last name. He's like a pretty hardcore day trader. So, like, there's all these segments on Twitter. There's, like, the buy and hold guys, there's the value guys, there's the growth guys, there's the day traders, the swing traders. And, like, I pay more attention to, the growth investors, the buy and hold. They're probably a little bit more similar to how I run my money versus, like, the swing trader and the day traders that are really, I mean, they're in and out of stocks so quickly. They're really playing either momentum or technicals. Like, that's never going to be me. When I see these people posting charts of, like, the candles, like, every single minute, and then trying to identify, like, waiting for, like, the perfect setup on the candles to when they enter the stock. Like, that would drive me crazy. Like, I don't want to be staring at candles 8 hours a day on my screen. But some people know how to do that. That's their preference, and they can do very well. That's just not how I want to run my money. So, like, I respect those people for what they do, but I don't really pay a lot of attention to them because that's just never a style that I'm going to pick up or that I even care about learning from. So, guys like Peru, Saxena, Chris, God, it's like, I'm trying to even Chris Peruna. I think I've never actually had to pronounce these guys' names before. So
there you go,
I mean, there's a lot of them. I mean, I follow a couple thousand people on Twitter now, and pretty much everyone I follow at this point is an investor or an analyst or a fund manager or CNBC personality, someone that's connected to the investment finance space in some form or fashion. So, I mean, if you're looking for people to follow on Twitter, feel free to go look at the people that I follow. I also follow, like, a lot of CEOs of companies that I'm interested in, and then the companies themselves. And then what I do is I do some CEO interviews myself. So typically what I try to do is, after I do a write-up on a company, or I at least spend some time doing due diligence, and I feel like I know the company well enough to ask some good questions, I'll reach out to the CEO or investor relations and try to set up an interview so that we can spend 20, 30 minutes talking about the company. And sometimes that's how I either, decide that it's not an investment for me, or sometimes that interview helps me build up the conviction to take a position. So, I think sometimes those, a lot of these, especially these small cap CEOs, you never really get a chance to hear from them, or
Yeah.
I mean, you like, they're not on CNBC. I mean, so it's not like CNBC and Bloomberg are bringing on these guys. They're bringing on the CEO of Walmart and Starbucks and Boeing and Bank of America. So I think these small cap CEOs need a little bit of help getting their message out there. And sometimes, I mean, you can listen to them on the earnings calls, right? I mean, they're gonna take questions from analysts and answer some questions. But I think in terms of like a retail investor like me, getting to do a face-to-face on Zoom and ask them 10, 15 questions, I think it just kind of, I don't know, it makes them like, they just seem a little more relaxed. Like if I was a CEO going on CNBC, like I'd be, you're always nervous about what question they're going to throw at you and who's watching this. Like I think when they're doing a Zoom, they're a little bit more relaxed and comfortable, and perhaps a little bit more willing to open up about things that they wouldn't talk about on CNBC.
No, I think that's a great service. We do the same thing. We're trying to, democratize access to the CEOs and these small companies that don't get the same, like you said, time on CNBC. So I think that's a great job you're doing, and it certainly helps everybody. Any favorite investment books? We've got a lot of sort of new investors, any suggestions in terms of where they start to get some info?
I mean, to be honest, the only investor or investment book I've read in the last few years is 100 Baggers by Chris Mayer.
Yep.
That's it. I mean, because I also feel like a lot of books get outdated very quickly. I mean, I know there's the Ben Graham books, and there's like these iconic books that are, timeless, as they would say. But like, I would argue that a lot of the stuff that gets written is outdated, within a few years. Versus like if you're, reading blogs or Substacks or, any write-ups that you come across on Twitter, or you're listening to podcasts, like this is current information, right? So I just, that's why I tend to stay away from the books, and I tend to spend more time on the podcasts and the blogs and stock write-ups and investor presentations. And I mean, go through go through the 10Ks and the 10Qs. Like that's where you always get some good nuggets. I'm also surprised, like back to the investor calls, earnings calls. I'm shocked by how many investors invest in companies and don't listen to the earnings calls, because you always hear something on there that you are not going to see anywhere else. And like, that's one of the things that got me bullish on Intrusion, listening to the Q4 earnings call when they talked about the pipeline. And he mentioned a few other things that I had not seen written anywhere. They're not in the investor presentation. They're not in press releases. The only time you're ever going to hear that is if you listen to those earnings calls. So I would suggest anyone that, before you, or maybe not before, but if you have a position in the company and you're just, I don't know, you're unsure about it, listen to those earnings calls is either going to help you stay in it or realize you may want to get out.
So we're running out of time here. I want to find out and ask you, where do you see yourself in 5 years? What are you doing 5 years from now?
I mean, I think I'll still be doing most of this. I've had a few people, some pretty big investors, backers, reach out to me asking if I want to start an ETF. And I've discussed it openly before. Do I want to start a small cap, mid cap growth ETF? Similar to ARK Investments, but obviously, I mean, nowhere near their size, but, going after similar types of companies, high growth, disruptive companies, obviously on a smaller scale, smaller market cap. And I think there is an opportunity for someone like myself to do something like that. The question is, though, for me, and this is what I'm kind of struggling with, if I did that, would I have to leave social capital? Could I still do my Substack or my stock twits? Could I still engage with people on Twitter and have these conversations, while I'm running a ETF as a SEC registered firm, right? I mean, once you sort of, take that next step and set up an SEC registered firm and actually have investment products, like what you can say and how you say it sort of starts to change. And, like I enjoy everything I'm doing right now. Like I enjoy doing the write-ups. I enjoy talking to retail investors and, you know, trying to help them find these companies. And I'd hate to have to give that up. But to my earlier point, like there's a lot of retail investors that shouldn't be doing it themselves. And if they had someone like myself running a strategy like this, they might, I mean, I know that they would, because some of that, you know, I get a lot of emails about it. Some would rather give me that money or a portion of their money to run that strategy for them, you know, rather than them going through the trouble of trying to do it themselves. So, you know, even if I did launch an ETF, I feel like I can still help retail investors. I'm just running the money for them rather than trying to hold their hand while they do it themselves. Right. So I don't know. I mean, my guess is that in 5 years, I'm either doing exactly what I'm doing right now, or I'm running an ETF. Hard to believe that I could be doing both at the same time. I just feel like I'm going to have to pick one path or the other.
Right. If people want to find out more about Jonah Lupton or anything you're doing, where can they get more information?
I mean, Twitter is probably the first spot I would go to. So my Twitter handle is my first and last name put together. So Jonah Lupton. I mean, I do have a website, so jonahlupton.com you can go to, and on that website is links to any projects that I'm working on or social media accounts that I run. So I'm pretty easy to find. I mean, if you just Google me, I mean, I'm not like I'm out there. So,
you're out there.
Yeah, I mean, like you can even find my cell phone number pretty quickly if you really wanted to. I always get like crazy calls and random text messages from people that want to ask me a question about a stock, and I'm like, how the hell did you find my number? And they're like, oh, I Googled you and it popped up. So
keep note of that. You're based in Boston, I think, or outside of Boston. Right?
I was in Boston before the pandemic started, and now I'm down on Cape Cod.
Okay, gotcha. Are you a Bruins fan? Are you a Boston Bruins fan?
I mean, out of the 4 sports, it's probably the one that I watch the least.
Okay.
So I'm more of a football guy,
okay.
And then probably basketball, baseball, then hockey. I mean, I definitely follow the team, but like I'm one of those like fair weather fans that kind of like just keeps an eye on the regular season and then jumps in and starts watching the postseason
and playoffs. Yeah.
Because
most of us are from Vancouver, so 2011 we weren't too happy with Boston. So
I will say there's nothing more exciting than overtime playoff hockey.
Absolutely.
That's of all the sports, that's the best, right? Absolutely. That's the most exciting is overtime playoff hockey.
Yeah, no, for sure. Well, listen, Jonah, thanks so much for joining us today. We've been speaking to Jonah Lupton of Lupton Capital, Social Capital. Find him on Twitter, find him on his website. I want to thank everybody for joining us today. And Jonah, hopefully we can catch up again sometime soon.
Anytime, man. I appreciate it.
Awesome. Thanks a lot, Jonah.
Thanks. Bye, guys.